On February 17th, videos circulating online showed nearly 1,000 people who had invested in Shandong province's Taishan Steel Group, gathering in front of the company's office building to protest, demanding Taishan fulfill its financing repayments and settle outstanding payments. Protesters chanted slogans such as "Pay us back, pay us back." Authorities dispatched a large police force and security personnel to confront the demonstrators and work to suppress information about the protest. Many related videos were quickly removed from Chinese social media, though some remain accessible overseas. According to Taishan Steel Group workers, the Laiwu district government demanded the company relocate 2 years ago, promising substantial compensation that remains unpaid. Last year, the government borrowed hundreds of millions from Taishan Steel to cover civil servant wages, causing the company's cash flow to break down and pushing it towards bankruptcy. Investors cannot recover their funds, and payments for goods are unsettled. On February 18th, Mr. Li, an employee at the Shandong company, told the media that Taishan Steel's financial collapse and inability to pay loans or settle transactions has sparked public anger. He explained, "The main trigger is the government's recent salary increases for civil servants, ranging from a few hundred to over 1,000 yuan, plus back pay for 6 months. While many grassroots civil servants now depend on state funds, numerous companies haven't paid wages for months due to government borrowing. In Shandong, news of these raises has spread widely, and I've confirmed it myself." Mr. Song, an employee at a Jinan company, said in an interview, "Private enterprises in China, especially high-performing ones, have close ties with the government. These ties involve policy support and easy access to loans when the government needs funds. If a connected company faces bankruptcy, the government may press profitable firms to offer financial guarantees. During budget shortages, it often borrows from successful businesses, causing cash flow issues for some and pulling strong companies under. When problems arise, the government typically denies accountability." Taishan Steel Group is a major private enterprise focusing on steel production, integrating multiple industries. It is Shandong province's only full-process stainless steel producer and the region's largest cold-rolled sheet production base. Taishan Steel Group, established on May 6, 1994, with a registered capital of 3 billion yuan, is led by Wang Yongsheng, son of former chairman Wang Shandong. Though a private firm, it maintains close ties with local authorities. In September 2020, Beijing News reported that the Liaocheng Intermediate People's Court restricted high spending by Taishan Steel and Wang Yongsheng due to a loan dispute with Shanghai Pudong Development Bank's Liaocheng branch. According to Phoenix News, in September 2024, the Dongchangfu District People's Court in Liaocheng ordered Taishan Steel to pay 144 million yuan for guaranteeing a loan for Shandong Guangzhou Dingxing Sheet Technology Company, which defaulted. The company's legal representative, Xiao Shudong, faces repeated high consumption bans and multiple bank lawsuits. A Chinese independent media figure called this a sensitive case, likely to heighten economic downturn worries, urging basic financial literacy in today's China. Taishan Steel's commercial paper, that is, the unsecured short-term debt, has defaulted, another financial risk event that's rattling everyone. How many creditors are now devastated, left in despair? Commercial acceptance bills have always been like a deceptive monster. They look similar to bank acceptance bills, but in reality, they're a financial trap. We once firmly refused to accept clients holding Evergrande's commercial paper. Who knows how they're doing now? If you're watching this, my advice is to stay away from commercial paper, especially if you don't fully understand the difference. Be cautious. The main difference between bank and commercial acceptance bills is who ensures payment. For bank acceptance bills, the bank guarantees payment if the insurer defaults at maturity or during early discounting. For commercial acceptance bills, the payer is responsible. If the payer's account lacks funds at maturity, the bank returns the bill to the recipient for both parties to settle. The payer also faces a 1% penalty of the bill's value, akin to bounce check rules. In China, commercial acceptance bills have long had a low credit rating, with fraudulent companies often using them for scams. According to a report by Hualien Network, the Shanghai Commercial Paper Exchange revealed that as of January 31, 2025, Shandong Taishan Steel Group had an overdue balance of 1.17 billion yuan. The report noted that, as one of Shandong's largest private enterprises, Taishan Steel had experienced multiple overdue bills since 2024. However, these were typically settled by the end of the overdue month, with the company issuing announcements attributing delays to financial staff failing to process payment requests in time. By December 2024, Taishan Steel failed to clear its overdue commercial bills by month's end, accumulating an overdue balance of 444 million yuan. The company was subsequently added to the Shanghai Commercial Paper Exchange's list of persistent overdue entities, leading to a 2-year suspension from issuing, discounting, guaranteeing, or pledging commercial paper. At the end of January, Taishan Iron and Steel's overdue balance further surged to 1.17 billion yuan, while its total outstanding commercial acceptance bills reached almost 2.8 billion yuan. As more bills reach maturity, the overdue balance is expected to increase. Li Hengqing, director at the Washington Institute for Information and Strategy Institute, commented, "China's economy is in a broad decline. The real estate sector has essentially come to a standstill, with many construction projects halted. With so few buyers, steel demand has plummeted." He added, "On the other hand, government investment in fixed assets, such as mines, railways, highways, and ports, has sharply declined. Infrastructure projects, once driven by public spending, have stalled due to a fiscal revenue shortfall. With these factors combined, steel sales have been severely impacted." In recent years, China's steel prices have kept falling, deepening losses for steel firms and driving many into financial trouble. In July 2024, Chinese media reported that Jiangsu Delong Nickel Industry, once a major steel player, and 27 affiliates were court-ordered into restructuring. Founded by Dai Guofeng, dubbed the Private Steel King, Delong became the world's second-largest stainless steel supplier after Tsingshan Group, with plants in Jiangsu's Yancheng, Chenzhou, Suzhou, and Taizhou, plus Indonesia. Rapid expansion caused a cash flow crisis, leaving it insolvent and facing bankruptcy. In 2024's first 3 quarters, China produced 768 million tons of crude steel, but key steel firms' profits fell 56.4% year over year. Since August 2024, steel plant losses have grown, margins have crashed, and demand has weakened. With unsold stockpiles, 32 mills announced maintenance shutdowns, while others closed due to bankruptcy, triggered by relentless price drops. On July 30, 2024, Taishan Steel billets hit a 4-year low of 3,120 yuan per ton, down 2,700 yuan from the peak recorded in May 2021. A Chinese social media user asked, "Several steel mills have gone bankrupt and steel prices have dropped sharply. How can such an essential material be so cheap? Shouldn't it be higher in demand? Does China no longer need steel?" U.S. economist David Huang said, "For over 20 years, real estate consumed more than 40% of China's steel. Its decline is the primary reason the steel industry is struggling." He added that steel demand once depended on China's robust infrastructure and housing growth, now mostly stalled with tight budgets. After 2 decades of construction, most roads and homes are built, overcapacity will persist. Huang also highlighted deeper economic issues tied to local governments and state firms. Since Mao's Great Leap Forward, China built many steel mills, mostly state-run. Recently, state firms have acquired private ones, gaining influence and pushing policies to sustain steel production, a complex bureaucratic challenge. In August 2024, China's MIIT paused new steel capacity approvals, marking violations as examples, effectively stopping new plants. Shanghai My Steel's information director, Xu Shangchun, explained that firms and local governments bypassed rules to boost steel production during capacity replacement, worsening overcapacity as demand drops. The MIIT's halt aims to stop this expansion cold. David Huang argues that China's economic and industrial structure is unsustainable. He said, first, GDP relies heavily on real estate and infrastructure. Second, government debt grows to fund these projects, an unstable approach. Third, the state-run steel industry follows a planned economy model, which fails in a market system. Huang warned that steel mill bankruptcies will cause widespread unemployment and financial strain. Many are listed firms, so their collapse could rattle China's stock and banking sectors, raising bad debts. He called these bankruptcies a clear sign of planned economy flaws, like past flops like bike sharing and EVs, predicting more closures ahead. Financial insiders said Taishan Steel's complex ties with local governments and others led to unpayable debt chains and mass defaults, a growing risk across China. China's economy faces widespread overcapacity in industries like steel, real estate, electric vehicles, high-speed rail, airports, and petrochemicals. Electric vehicles, the latest and worst-hit sector, are entering a fierce shakeout. Competition in 2025 is expected to be tougher than ever. The Wall Street Journal reported in January that XPeng Motors CEO Hu Xiaopeng wrote in a December internal email, 2025 to 2027 will be the auto industry's knockout round. 2025 will be more intense than past years. The report said this shakeout stems from Beijing's industrial policies. Subsidies and support boost favored sectors until they can hit critical mass, then the market cuts down the weak. It noted similar patterns in China's solar panel, wind turbine, steel, and electronics sectors. The auto market is oversupplied, with EV demand well below capacity. Price wars among Chinese brands are inevitable, leaving few firms standing. According to reports, 23 electric vehicle brands exited the Chinese market or merged with other brands in 2024, while over a dozen new brands entered. But the average capacity utilization rate of Chinese automakers was only around 50%. China's EV industry is mirroring the trajectory of the steel sector, but at a much faster cycle of boom, overexpansion, and collapse. This impending wave of bankruptcies and corporate mergers will inevitably lead to mass layoffs, further worsening China's economic situation. Over the past year, China's layoffs have extended beyond private companies to state-owned enterprises and even government jobs, which were once considered iron rice bowls. Many highly educated individuals, including PhD and master's degree holders in government agencies, have been caught off guard by sudden dismissals. Online commentators have noted that the worsening economic crisis leaves no option but to cut public sector and state-owned enterprise jobs. Relying solely on squeezing private businesses and ordinary citizens is no longer enough to fix the economy. Raising taxes, issuing traffic fines, manipulating hospital fees, tampering with utilities, extending retirement ages, none of these tactics are working anymore. Financial experts in China argue that the root cause of China's unemployment crisis lies in excessive degree inflation, caused by decades of education system commercialization. Since the 1990s, China's education industrialization policy has devalued higher education degrees. Today, many bachelor's, master's, and even PhD graduates lack the skills that previous vocational school graduates had. The country now faces a severe case of academic overproduction, where highly educated individuals struggle to find even basic jobs. China's civil service system has the highest ratio of government employees in the world, a reflection of the Chinese Communist Party's authoritarian control, as well as a severe case of excessive bureaucratic overcapacity. The collapse of Taishan Steel symbolizes the steel industry's overcapacity crisis and marks the beginning of China's economic downturn in 2025. The CCP once hoped that the Belt and Road Initiative would absorb the excess steel capacity, but as China's global influence wanes, the initiative has reached a dead end.